Welcome to Mayor Brown's Global Financial Markets Podcast. Each 30-minute episode is designed to help listeners better understand the legal issues that impact their business given the ongoing uncertainties in the financial markets worldwide. Speakers from across Mayor Brown's practices and offices provide their timely insights on a wide range of topics, including finance, financial services, and insurance regulatory developments, securitizations, and litigation in the United States, the United Kingdom, Europe, and Asia. We hope you enjoy the program.
Hello, listeners. Our topic today is how securitization and structured finance may be affected by the recent U.S. Basel Endgame capital proposal. My name is Matt Bisanz, and I'm a bank regulatory partner in Mayor Brown's Washington, D.C. office. Joining me today are two structured finance colleagues, Stuart Litwin and Chris Horn. Stuart and Chris have been longtime lawyers with the firm, and Stuart is colloquially called the godfather of ABS because of his work in securitization. And as some people may know from the earlier episodes in the series on the capital proposal, it really touches all areas of a bank's balance sheet. And so I'm really appreciative that Stuart and Chris are here today to talk about how the proposal touches on securitization and other structured finance. With that said, I'm going to give a little background on the proposal if this is the first episode you're tuning into, but I would recommend you listen to the earlier episodes from last month. In July, the U.S. banking regulators proposed changes to the capital requirements for larger banking organizations. This is the 40 or 50 largest banks in the country, names that many of us know and names that maybe are not as familiar, but they provide vital functions to many consumers, to small businesses, large businesses, and the global trading markets. The proposal is wide-ranging and would affect the capital requirements for credit risk, that's the risk of default or non-payment, market risk, that's risk of price changes, volatility, those types of risks, and then operational risk, which is the risk of something going bad, things like a building catching fire, a hacker compromising a system. The proposal also touches on areas such as the recognition of unrealized losses on securities holdings. It touches on parts of the leverage ratio with the way derivatives are calculated. Many of these changes are highly technical. It's over 1,100 pages long. And we, like as you saw with our earlier episodes, we could spend an hour talking about the changes to the risk weights for credit exposures alone. But today we're here to talk about securitization because within the credit risk stripe, some of the most significant changes are to securitization exposures and the way that banks will calculate their risk weights or their capital charge for securitization exposures. And so while there are many other changes, and I can't stress enough that for each user of the capital regulations, for each part of a bank, they probably think their part is the most important. And today, securitization is the most important. Do keep in mind that this fits into a larger framework of a comprehensive revision to the risk weights for all credit instruments. So pure loans, pure securities holdings, exposures to governments, exposures to other banks, derivatives that are not held for trading purposes, off-balance sheet commitments like undrawn credit card lines and letters of credit and other types of forward exposures, and also even equity exposures to non-public equities that are, again, not in the trading book that a bank is holding for investment purposes. So the risk weights for all of these exposures are changing for credit purposes. In addition to the changes we're going to talk about today for securitization, we're also at the end of the talk today going to touch on how securitization is affected by the changes to market risk and operational risk that typically we don't think of securitization as having a large market risk or operational risk component because it really is a concentrated form of credit risk. That's one of the points of securitization. But the capital rules do slightly adjust the economics for some securitization revenues and also some risks for certain types of traded securitizations. And we'll touch on that at the end. But I've already talked enough, and I want to turn things over to Stuart to really dive into securitization risk.
Thanks a lot, Matt. Really glad to be here with all of you today. So the securitization aspects of the proposal really affect banks mostly as lenders and investors, and a lot less as issuers or sponsors of securitizations. Probably the most important set of changes is that as lenders and investors, banks are no longer allowed to use internal models. They will, under this proposal, they would no longer be allowed to use internal models. And instead, we'd have a modified version of the SSFA, the securitization essay. And what we'd have are standardized rules, effectively, that apply to lending transactions that banks do that are securitization exposures. Mayor Brown and this particular group are going to be representing a number of the trade associations in their comment letters. So some of the things that I'm going to be talking about are some of the things that I expect that we will very much comment on. So when you get into the math, and Chris is going to talk a little bit more about the math when I turn it over to him. One of the things that I absolutely expect all of the comment letters to include is a comment about the proposed increase in the P factor from 0.5 to 1.0. And the P factor, when it all comes down to it, is just a goosing up of the capital requirement for securitization forms of lending that doesn't apply to non-securitization forms of lending. So what it effectively is a discrimination against securitization. And I absolutely expect that we will all be commenting on that, every one of the comment letters that thinks about securitization. So why is that? And I think in order to understand why, that's how, why do we have a P factor at all? And after the financial crisis, which a lot of folks thought might have had, that securitization was an important cause, a lot of the regulators around the world thought that securitization was particularly risky compared to other types of activities that banks might do. And frankly, in some cases, some of the regulators, in fact, perhaps might have thought that securitization was downright evil. And as a result, they had this goose up to the capital requirements if the bank was in fact going to be involved in securitization activities and was going to have any kind of securitization lending or investing. And then, the Basel proposal increased the P factor over and above what it had been in the earlier version. And so under the proposal, we'll have a P factor of 1 rather than 0.5. So again, without getting into the math, it's an increase, and it's an increase in this sort of securitization surcharge. There's no analysis whatsoever in the proposal, no explanation of why they're doing it. They're just adopting it because, frankly, it's in Basel. But one of the interesting things is that under the European capital rules are reconsidering this. And also in Europe has STC securitization. So there are two kinds of securitizations in Europe. The simple, transparent, and comparable securitization framework that has lower capital requirements, and then everything else that has higher capital requirements. And we don't have enough time to get into the details of STC, but in the US, we have strongly campaigned against the idea of distinguishing between what might be higher quality securitizations and lower quality securitizations. And, the theory has always been that that would really affect the creativity and really affect the diverse development of our securitization market. So effectively, what we would be doing is applying the standards for the lower quality securitizations here. And this completely ignores that, if you had two loans, one's a securitization loan, one's not a securitization loan, but they're equivalent in credit quality. It completely ignores that the securitization loan has a bankruptcy remote structure, has first loss enhancement. Likely the non-securitization loan, the corporate loan, is probably going to get paid, only on its final maturity date, where the securitization loan is going to get paid, all along the way and have a shorter weighted average life. And it completely ignores the fact that in much of the securitization lending that banks do, many would consider that kind of lending to be a treasury equivalent. And, many of those deals are structured to a AAA or AA equivalent. And so that's the first thing. The second change I'm going to talk about that I think folks will comment on in the comment letters is, you may call it good news, the lowering of the risk weight floor from 20% to 15%. And again, if you're starting out with a 20% floor, we end up at 15%, that's good news. On the other hand, what's the purpose of the floor? Again, the purpose of the floor is another place where we have this discrimination against securitization. And I think all of the comment letters are going to come back and say we shouldn't have any floor compared. Securitization shouldn't be treated any worse than other forms of lending. The next thing on the list is that there are some changes in the operational requirements for synthetic securitizations. And I'll talk about two of them. One is that if you had early amortization provisions, so you hit a credit trigger and then you're going to sort of pay out the securitization investors more quickly, protect them against losses, that would disqualify a synthetic securitization. Another disqualifying feature would be if you applied excess spread. They define it in the proposal as synthetic excess spread. If you applied excess spread to losses, that would disqualify your transaction. Now let's focus on that for just a second. So let's hypothetically assume that you have two portfolios, one of which is a super prime low interest portfolio, and the other one is a much less creditworthy subprime portfolio where those assets have a much higher interest rate. Why do they have a much higher interest rate than the super prime assets? And the reason, of course, is because you expect to have higher losses, and the higher interest rate has to cover those higher losses. That's in fact how you're running that business. You're charging higher interest rates to cover the losses on the portfolio. So why does it make sense that we can't apply that higher interest in a synthetic transaction to cover losses before we make investors take the risk of losses? So I think we'd expect to see comments on that. Now, another aspect of synthetic securitization, some of the issues in the recent past with synthetic securitizations, that have affected the credit-linked note structure. Again, we're time challenged here, so we're not going to get into detail about this. But some of the technical issues that have gotten in the way of credit-linked note structures have not been addressed in this proposal, and we are expecting that the comment letters will absolutely, ask for those issues to be addressed. Okay. Again, in the interest of time, I'll just simply mention that resecuritizations have been made to be, the treatment of resecuritizations will be worse than it was before. Effectively, resecuritizations it's going to be prohibitive to do resecuritizations. Aside from the securitization framework, I know Matt's going to talk about the operational credit risk aspects a little bit more, but one thing that I'll mention is that the operational risk capital charges will now affect most bank fees and commissions, and that would include underwriting fees, trustee fees, gains on sale in securitizations that get off balance sheet, servicing fees. So to the extent that banks are earning fees in connection with securitizations and frankly in lots of other aspects of their business, there will now be a capital charge on those fees, and that will certainly have an effect. And under certain circumstances, unrealized gains and losses will in fact be taken into account on available for sale securities, and that's probably going to have some effect. And with that, I'm going to turn it over to Chris, who's going to talk a little bit more about the math and some other aspects of the proposal.
Thanks, Stu. Right. So Stu had mentioned, this existing standardized approach, which utilizes the SSFA model, and the new proposed expanded standardized approach, which uses the SEC SA model. Those two models are the same functionally, their functional mathematical form's the same. What they do is they take some inputs and calculate securitization risk weights from them. So they take the risk weights or the capital requirements associated with the underlying assets. That model, both models adjust for defaults as they occur over time. The models also take as inputs the attachment point of the tranche and the detachment point of the tranche. And so for all those variables, it utilizes an exponential decay function to calculate risk weights at every part of the capital structure, and then calculates the risk weight applicable to a tranche by calculating the area under the curve. And this P factor that Stu has been talking about is utilized in the decay rate of that function. So as you move up in seniority, risk weights decline, which makes sense. P governs the rate at which they decline. The way to bottom line all this, though, and as Stu was alluding to, is as a securitization capital surcharge. So if you think about the amount of capital that a bank would have to hold against assets that it holds just directly on its unsecuritized in its unsecuritized portfolio, compare that to what the capital charge would be if it held every tranche of a securitization backed by those assets. If you compare those two capital requirements, then you can kind of calculate a securitization capital surcharge. The regulators don't refer to it as such, but that's effectively what it is. And so the P factor under SSFA, as Stu mentioned, under the standardized approach is 0.5, and that corresponds to a 50% surcharge. In other words, you hold 50% more capital in securitized form than you would in unsecuritized form as a bank. Raising it to 1 changes that to 100% surcharge, so it doubles the surcharge. 1.5, which is the rate that applies to resecuritizations, corresponds to 150%. And really, when you look in the proposing release, as Stu mentioned, there's very little discussion about it. One sentence that they do have in there is, they note that under this expanded standardized approach, some of the risk weights on some of the underlying assets are going down. For example, auto would be, rather than 100, would be 85% under the expanded approach. But what they don't really explain is why creating, more granular, more refined risk weights of underlying assets means that the risk weighting for securitization exposures is degraded somehow, such that an increase in the P factor is necessary to offset that. But in any event, the effects are substantial. As Stu was mentioning, that the floor is an additional discrimination, so to speak, against securitization, in the sense that would increase, to the extent the bank holds a tranche and it's subject to the floor, that would increase the surcharge even more. The final point I would make, though, I think the more important effect is as assets default over time, which they inevitably do, the underlying risk weight for those assets is 150% under the proposal, whereas for purposes of the model, those assets get moved into a bucket that effectively assigns them a 625% risk weight. That's the KA calculation. So as you go on over time in the securitization and losses accumulate, the securitization capital surcharge, which is already very, very high at the inception of the deal, becomes even larger and rapidly so. With that, Matt, I think I'll turn it over to you.
Thank you, Chris. So Stuart and Chris have done a great job of talking about the credit risk implications for securitization, which are really where the majority of the proposal touches on. But as I mentioned at the beginning of this, there are capital requirements for market risk and operational risk. And market risk, as I said, refers to the change in price of an asset. And for most banks, to the extent they have a securitization exposure, it will be held in a credit risk capacity, that they'll be holding it either as they're issuing a securitization or they are investing in a asset-backed security for a long-term holding purpose. And so they won't have a trading exposure, it'll be a credit exposure. But it is possible to hold an asset-backed security as a trading exposure based on the person's intent in holding it. That you might have a Fannie or Freddie RMBS that is actually fairly tradable, that you intend to trade on a regular basis. And so that kind of item could go into the market risk book. And for market risk purposes, the proposal would put in place more requirements for banks over 100 billion. And by more, I mean more technical, that there would be about 5 formulas you have to calculate for each exposure, and you would need to do it on the basis of a trading desk. And so already banks, I think, are somewhat reluctant to have market risk items, and this change in complexity will drive them even further toward booking items in the credit book and maybe avoiding that trading intent. The second change to operational risk that Stuart alluded to is the regulators have this idea that banks need to hold separate capital against operational risks. And I question it because operational risk really isn't correlated with credit risk, that just because I default on my credit card doesn't mean someone's going to hack the bank. But it is going to be a separate charge, and it's going to be based on banks' revenue, and the largest driver of the charge will be revenue from services items. So things like loan servicing fees if the bank performs servicing for third parties, gains and losses on securitization sales when a bank is placing assets into a securitization. Custody fiduciary services will be another category, and things like insurance brokerage, credit card interchange, things that aren't securitization related. But the upshot is that it will be a charge on the revenue from these activities. And so it will in some ways discourage banks or force them to price these services higher. That we know, for example, loan servicing already is a very low margin business. And so putting any kind of capital charge on the revenue from loan servicing will affect how banks do it, and if banks will continue to provide some of these services, or if we will see them migrate to the non-bank sector. But again, on the whole, these charges are fairly minor to securitization compared to the monumental items with like the P factor that Stuart and Chris were talking about. Chris, do you want to close us out?
Sure thing. Thanks, Matt. And thanks to the audience for listening. Listeners, if you have any questions about today's podcast or anything else related to global financial markets, please email us at gfm@mayerbrown.com. Thanks for listening.
We hope you enjoyed this program. You can subscribe on all major podcasting platforms. To learn about other Mayer Brown audio programming, visit mayerbrown.com/podcasts. Thanks for listening.